Most beginners are comfortable with simple journal entries because they only involve two accounts, one debit and one credit. But in real business situations, transactions often affect more than two accounts at the same time. For example, imagine a customer pays part in cash and part by bank transfer, or a business pays salaries and tax deductions together. Now, we have more than two accounts involved. Does accounting break? Not at all. That's where compound journal entries come in. By the end of this video, you'll know exactly what compound entries are, how they work, and how to record them confidently. So what is a compound journal entry? A compound journal entry is simply a journal entry that involves more than two accounts. You might have multiple debits and one credit, one debit and multiple credits, or multiple debits and multiple credits. The number of accounts doesn't matter. The rule never changes, which is total debits must equal total credits. That's the only thing accounting cares about. If debits equal credits, your entry remains balanced. Let's compare a simple entry and a compound entry side by side. On January 1, Alex starts a consulting business and invests $10,000 cash. Now, this is a very straightforward transaction. Alex is putting money into the business, and in return, the business receives cash. So only one asset is involved here, cash, and one source of funding, which is the owner's capital. So this would be our entry: debit cash for $10,000, credit Alex capital for $10,000. And this is a simple journal entry. Now let's look at the second situation. On January 1, Alex starts a consulting business and invests $10,000 cash and equipment worth $1,000. Take a moment and compare the two. What actually changed? In this case, Alex is still investing into the business, but now it's not just cash anymore. The business is receiving two different assets instead of one: cash and equipment. So instead of one debit account, we now have multiple accounts being affected on the same side of the entry. That's the key idea behind compound journal entries. Nothing changes in the rules. We still follow the same accounting equation, and we still make sure debits equal credits. The only difference is that more than two accounts are involved in a single transaction. So instead of writing two separate journal entries for cash and equipment, we combine them into one structured entry. Here's how our entry would look like: debit cash for $10,000, debit equipment for $1,000, credit Alex capital for $11,000. And that's exactly what we mean when we say compound journal entry. One transaction, multiple accounts, same balancing rule. If this makes sense, you already understand the core idea. The rest is just practice and recognizing patterns. Let's look at a few more examples of a compound journal entry. On January 5, Alex Consulting Business purchases office supplies worth $500. However, the business does not pay the entire amount immediately. Instead, it pays $200 in cash and agrees to pay the remaining $300 at a later date. To record this transaction, we first identify the accounts involved. Office supplies increases because the business now owns more supplies. Since supplies are an asset, the increase is recorded as a debit. Therefore, we debit office supplies for $500. Next, cash decreases because the business paid $200 immediately. Since cash is an asset, a decrease is recorded as a credit. Therefore, we credit cash for $200. The remaining $300 creates an obligation to pay the supplier in the future. This increases accounts payable, which is a liability. Liabilities increase with credits, so we credit accounts payable for $300. Notice that one debit is matched with two credits. This is what makes the entry a compound journal entry. Now let's look at another common business transaction. On January 8, Alex Consulting Business earns $2,000 from consulting services. However, the customer only pays $500 immediately. The remaining $1,500 will be paid in the future. To record the transaction, we first again identify the accounts affected. Cash increases by 500 because the business receives money immediately. Since cash is an asset, the increase is recorded as a debit. The remaining 1,500 represents money owed by the customer. This increases accounts receivable, which is also an asset. Because assets increase with debits, accounts receivable is debited for 1,500. Looking at this, the business has earned revenue totaling 2,000. And revenue increases with credits, so service revenue is credited for the full amount. This example shows another common pattern of a compound journal entry. Instead of one debit and multiple credits, we now have multiple debits and one credit. Even though the structure is different, the rule remains exactly the same. Total debits must equal total credits. So far, we've seen both major forms of compound journal entries. Now, it's your turn to practice. Take a look at this transaction and see if you can identify all the accounts involved before looking at the answer. On January 10, Alex Consulting Business incurs 200 of utilities, pays 700 rent in cash, and Alex withdraws 300 cash for personal use. There are several things happening here, which makes this a great example of a compound journal entry. I'll give you a few seconds to try writing the journal entry on your own. Let's work through this step by step. First, the business incurred 200 of utilities. Since utilities are an expense, utilities expense increases. Expenses increase with debits, so we debit utilities expense for 200. Next, the business paid 700 rent in cash. Rent is also an expense, so rent expense increases and is debited for 700. Alex then withdrew 300 cash from the business for personal use. Owner withdrawals are recorded in the drawings account. Since drawings increases, we debit Alex drawings for 300. Now, let's look at the credit side. The business paid a total of 1,000 in cash. That's 700 for rent and 300 withdrawn by Alex. Since cash decreases, we credit cash for 1,000. Then, we saw the utilities were incurred but not paid. Because the business still owes that amount, accounts payable increases by 200. Liabilities increase with credits, so we credit accounts payable for 200. You can also use utilities payable. Notice something interesting about this example. Unlike our earlier examples, this transaction has multiple debit accounts and multiple credit accounts. Even though more accounts are involved, the accounting rules remain exactly the same. And again, its total debits equal the total credits, so the journal entry remains balanced. Now that we've seen all the common forms of compound journal entries, let's summarize the key points from today's lesson. A compound journal entry records a single transaction that affects more than two accounts. Throughout this lesson, we've seen different forms of compound journal entries. Some had one debit and multiple credits, others had multiple debits and one credit, and in our final practice question, we saw an example with multiple debits and multiple credits. Even though the structure may vary, the accounting principles remain exactly the same. And the most important rule to remember is that total debits must always equal total credits. As long as the entry stays balanced, you're applying the same accounting system you've already learned. And that's it about compound journal entry. But before you go, let me know in the comments, what part of compound journal entries is still unclear? If there's anything you'd like me to explain further, I'd love to hear your feedback. In the next lesson, we'll learn about ledger accounts and see what happens after journal entries are recorded in the journal. Thank you for watching this video, and I'll see you in the next lesson.